one of the big challenges that CEOs have across all industries, not just insurance, is they don't really understand, and this is not a criticism, it's just a fact of life, what their CIOs and CTOs are telling them. So they don't necessarily know what the right decision is to make, and they're very scared of going down that route of an irreversible decision and making the wrong choice.
Welcome to the Voice of Insurance. I'm Mark Gagan. The voice you just heard was Matthew Grant of Instech London. I caught up with Matthew and fellow Instech London founder Robin Mertens earlier in the month. Matthew and Robin are decades-long veterans of what we now call Insurtech. Matthew helped pioneer catastrophe modelling and worked for 20 years at RMS, and Robin is best known for his time at RI3K, the pioneering electronic insurance platform whose technology survives today in the heart of the London market's PPL electronic placing platform. The pair have spent careers bridging the often sizeable gap between insurance and technology. Back in 2015, they founded Instech London, which hosts a regular monthly get-together for entrepreneurs, venture capitalists, service providers, and people working in the incumbent insurance industry. The organisation has blossomed and now produces podcasts and newsletters as well as the events themselves. I always go to the events whenever I'm free because they're the best possible way of finding out what is happening with tech and its relationship with insurance. And it's also a really good way of me working out what I should be doing about all of that. In this episode, we have a wide-ranging discussion that includes a debate about the difference between merely digitising and going fully digital, as well as an examination of insurance's often really difficult relationship with technological change. Now, a couple of explainers before we get going. To non-Londoners, you need to know that Addison Lee is a taxi company that around the turn of the millennium embraced technology. It was one of the first to do so. It embraced technology and sat-nav and was able to give pretty accurate arrival times for taxis, as well as the first time we'd had binding fixed pricing, and that was when you called them up on the phone. Also, if you don't already know what IoT is, it's the Internet of Things, which means the brave new world of billions of internet-connected devices and sensors everywhere that is going to transform almost everything, and not least the world of risk. We also mention some specific startup companies that you might not know the name of. So those are Consiris, Exante, Riskbook, and Blink. I will make sure we put links to their sites in the podcast notes that accompany this podcast. So enjoy the podcast. I started off by asking Robin Mertens to introduce himself to our listeners.
Thank you. Thanks, Mark, for those kind words about Instech London. Yeah, I'm, as you say, co-founder of Instech London. My background is partly in insurance broking. Then I did my own .com startup. And then from 2015, Instech London has become increasingly a full-time job.
Is it? You're in the fifth year. When would be the fifth anniversary?
April next year.
So wait a minute, is that 4 years?
4 and a bit, yeah, nearly 5.
So it's nearly 5. So April 2020.
Yeah, exactly right.
Okay,
yeah.
So it is 5 years, yeah, right, okay.
Yeah, like all great startup companies, these companies have been sort of running for quite some time before you actually start to really get to know them. But certainly, what we've been doing and the exposure globally has really taken off. So my background, I spent over 25 years in and around catastrophe modelling. So really one of the earliest examples of insurance using data and analytics to really make a difference. And importantly, helping insurance companies understand their exposure and be more effective about how they.
Was that all at RMS?
No, it wasn't all at RMS actually. There was a company called EQE before that then ended up being absorbed by CoreLogic.
Oh, so yeah, was that what was it? Was it called Equicat for a while? Or we used to call it Equicat.
Yeah, again, like all an interesting measure of companies, how many times it changes its name. So I think it went through about 5 different evolutions of the name before it finally settled under the CoreLogic umbrella. So, I mean, the main thing is that both of you have spent your whole careers interacting between technology and the insurance market. Robin, you spent a lot of that. I first knew you at RA3K, risks for the third millennium, of which I suppose the kernel of some of that technology is now residing still in PPL, the London Market Electronic Placing Platform. You've been quite vocal, Robin. Something that really got my attention recently was an article that you posted on LinkedIn about the
difference, a subtle difference between digitising and going fully digital. And I'd really like you to explain some of that. And now that we're in an audible format, for anyone who hasn't read that yet, go through some of that, because I think it really encompasses a lot, the fundamentals of what Insurtech is all about.
No, by all means. This is a sort of pet theme of mine at the moment. I got very excited when Insurtech started up because I thought it was a sign that true disruption was on the horizon. And then 5 years in, I can see that there have been some successful Insurtechs, but I don't see that converting into any level of genuine disruption in the insurance industry. And my thought process here is that it's because the industry is only interested in digitising what it has rather than moving to a true digital model. So it's taking small parts of the value chain, either going to big tech companies and asking for solutions, or going to Insurtechs who have built something relevant and engaging with them and making small improvements. I used in my article the example of taxis, cabs, where the old model that many of your listeners will remember is to stand in the street and hail a black cab and wait a long time, and at some point at the end of the journey you had no idea how much it was going to cost. Someone would hand you a paper invoice and you would hand over the cash, and that was the transaction. That seems to me, the old Lloyd's model. Then the digitized version of that is Addison Lee, the possibility of ordering online or by telephone, of getting a fixed price, possibly getting an email invoice at the end, and then they probably had sat nav to help them navigate. So there are little bits of digital kit.
So they were using. They were quite predictive as well. They would be fairly accurate about when the cab was actually going to arrive to pick you up, and then they'd be very accurate on the pricing. The price was fixed, wasn't it? So it was a big improvement on what was going on before.
Yeah, really similar to what's going on. I mean, so that the bits weren't joined up. Your payment piece wasn't joined up to your sat nav, which wasn't joined up to your pricing capability, but they were all digital in their way. And then because we soon got used to it, the true digital model is Uber. I mean, we all kind of get out of a cab. We don't do anything. The driver presses a button, and we get an invoice, and we pay, and the user experience is extraordinary at the front end. We know at any given moment in time where the whole cab is, and to do that you have to re-platform. I mean, you have to completely rethink the way you provide that service from a technology point of view. And my frustration, which is the subject matter of that article, is that there's a limited period of time that you can then go on and on digitizing pieces, and at some point I think you have to look at when do we really grasp the nettle, which is a proper digital model. And I think it's not quite as far away as everybody thinks, because I think there are big opportunities that come from it, and I'm imploring the industry to start thinking about it.
You've got to be positive about it, I suppose. So what you're saying is, whilst all of us in the London market, or in the global sort of syndicated specialty and reinsurance markets that I've been covering for most of my career, they would dearly love just to have faster horses, using the sort of Henry Ford analogy. But there's just a time when you just need to hop into learn how to drive a proper car. Otherwise, you're going to be left behind. Is that what you're saying?
Look, there might be a few more years left in it. The industry is safe right now, because while none of your competitors grasp that nettle, then you don't have to grasp the nettle. But I think that there are some Insurtechs that are now very close. They only need risk capital to become a full end-to-end, properly thought-out digital model. I think there are companies on the continent who have built them that look like pretty sophisticated to me. But I mean, Matthew makes a very good point around this, which is if you haven't got the right technology, then many of the models of the future, the classes that you need to insure, the way in which you need to insure them, the dynamic nature of the data that you interact with, are not open to you. I mean, you've been making this point for some time.
Yeah, I mean, I think there's two things there. I think one, just coming back to this point about the technology change. Yeah, I think part of the problem with the term insurtech is a lot of people look at it and think about it being a couple of people doing some startup coming in to disrupt the industry, and actually don't really understand the technological change is more than just that narrow focus on it, and it's not enough just to look at some of the organisations out there that are trying to do some things differently and say, well, they're not really relevant. But I think back to this point about data. Yeah, I mean, certainly, as everyone in the insurance industry is aware, the search for new premium and new revenue is always much more exciting than another way to assess a risk that's already in there. And the big challenge, of course, then is, well, how do you have the confidence to write these new emerging risks, these intangible risks like cyber or IP or supply chain or reputation, that it's really hard to sort of really understand. And I think there's it's a double-edged sword here, because on the one hand, access to data is great, but until people can get access to that data, it doesn't mean they should give up underwriting altogether. And I think there's a risk sometimes of regulation that it goes too far and actually demands the data and actually then constrains people from underwriting. And we're seeing a bit of that with crypto. Potential to insure crypto wallets and crypto assets is really big, but it's being limited by regulators saying that how much people can write is constrained by their capacity. But I think part of the technological change we are going to see coming in, and definitely will make a difference, is access to things like sensors and telematics and IoT coming in from buildings, and related to cyber and related to machinery, and really other ways of just looking at what will be a much more dynamic view of risk and underwriting.
So we're going to be talking about everything, much more dynamic pricing, that sort of thing, the sort of thing like in cyber, perhaps, where everything's going to be changing almost real time. Obviously, we're going to start seeing this properly in motor. I know there's a few insurtechs out there that are properly doing this. It just does seem crazy that actually that's the first sort of one of the earliest insurtech applications. And it just seemed, I was surprised to hear that no one's actually done proper live or attempting really, really live motor pricing until recently, where that's been happening. But it's fair to summarise for both of you that you're still absolutely true sort of digital believers, and anyone who's listening to think, this insurtech thing, it's been okay. It's all about building slightly better tools for incumbent insurers to stay being better incumbents and keep competing away. That's not the case. Do you think there's a threat, but it's a positive threat? It's something that just needs to be grasped and then brought to your advantage.
Look, I'm terribly aware of being a stuck record, in the sense that I've been banging the same drum for 20 years and not much change, and I kind of am very conscious of that. But the biggest thing that changed in Instech London's dynamics in 2019 was how many big companies sought us out. Our first event this year was MasterCard sponsored. Our second event is Google. We have other big companies on our membership roster now. And while we retain our passion for helping startups, they're all circling our space because they have assets that they want to deploy. And increasingly they're saying to us, we find it difficult to deploy these assets in this industry because there's too much legacy kit for us to join up with. When we mash our true digital offering with some 1980s policy admin system, we get compromised by that. So they're seeking out insurance companies and actually increasingly insurtechs with true digital models, because they know that that's going to be the best way to deploy. And I think that's going to be part of an influence and a driving force on what these toys will be not open to you to use until you have the right model which makes them fully optimized and usable.
I was at that event, the MasterCard event, which is your first event of the year early in January, and I was mightily impressed. I think it's only when you have someone sitting, in the global specialty and reinsurance space. You have Lloyd's of London. You say, and it sounds impressive when Lloyd's of London said, we've got 200 or 300 licenses around the world. You plug in, you can do insurance anywhere. We're the great hub, and then you contrast that with MasterCard, and you think, God, you're in every country in the world. You have I can't remember the exact figures. It was in the billions of customers, and you're thinking, and of course, and you're regulated in more than 223 different countries or whatever it is, which suddenly put everything into context. And I don't know how many trillions it was that they actually move around every other day, but it certainly put sort of insurance in its place, and I was mightily impressed with that. I'm also very much looking forward to this Google event that you're putting on at the end of this month. So,
well, thanks, Mark. So, a quick plug for our Mastercard podcast that's coming out, and it's got all the facts and figures in it. But one of the other theme that was mentioned there by Ian Slater, who's SVP for Enterprises for Mastercard globally, and it's something we're hearing more and more of, is people look from outside of insurance and actually really like what they see. I think if we spend too long in this market, we all get a little bit sort of sense that it's not really the best place in the world to be. But whether that's people doing startups, and again, quite a few people like Eric Abrahamson at Digital Fine Print, went out, could have gone anywhere and did his research and thought, insurance is a place I can really come in and actually make a difference. And so I think part of this is a recognition that there's so much rich source of information that can help people. And fundamentally, we shouldn't forget that insurance is actually to make people's lives better. I mean, we are there to basically get people back on their feet after a loss has been suffered. So I think part of this element around the whole digitization and digital and where do we go next is people just being proud of the market they're in and proud of being in Lloyd's and actually look forward from a much more positive way. It doesn't mean the problems aren't still hard to solve, but coming at it from a much more positive outlook, I think, is a sort of small shift that maybe we'll start to see in 2020.
You've been talking a lot about down at Instech, and obviously I'm a regular. You can't keep me away from those events, and they're absolutely incredibly valuable. And I would recommend any of our listeners to go along if they're in London, and they've got the time. You were talking about ecosystems. And that this will be coming to the fore in Insurtech. Can you explain what you mean by ecosystems? In a digital sense.
Certainly, and I think ecosystems is a sort of it started life as a management consulting word and has sort of
because it might it might turn some people off who are listening to this and think, but actually know that. There's a kind of a really good idea in there, isn't there?
Yeah, no, I've tried to find a better word for 5 years and I've now given up because I think ecosystems is the right word. I think increasingly what happens is that the various worlds in which we live our daily lives can join. So I don't think in the future insurance operates as it does now in a completely and utterly separate world where people just buy insurance and they are prepared to separately transact for insurance. So I think increasingly your utilities providers, your bank, your retail starts to live in worlds where you're very, very closely linked, and they are already linking up. So I see a world in which you're just as likely to be asked by Scottish Power, who provide your gas, whether you'd like property insurance, because they already have a way of a monthly. You already have a monthly bill with them. They already know enough about you. They are much smarter at getting access to third-party data sources. They only have to do a deal with AXA on how they price and how they provide that. And all of a sudden, it's not a risk that's come in through the traditional channels.
And of course, they've got a labour force to come and fix leaks and other things, right?
So they've got those bits already, and they're starting to look at those bits coming together, and they're saying, how else can I now leverage the fact that I have a trusted brand, I have the customer, I understand the customer, I know a lot about the customer. I'm not going to just sell them power. I'm going to sell them lots of other things. Insurance looks to me like something that you can add on to those things. The banks returning, in a big way to bank assurance. They've had their own issues, but there's a lot of money and thought going into how the banks would return, particularly the challenger banks, who see this as a really big opportunity.
So it's about cross-selling, and of course, anyone who's been in the insurance industry for long enough will, remember the late 80s and the whole of the 90s. But bank assurance was absolutely where it was at until suddenly things like Direct Line came along. But that was such a massive part of insurance growth in the late 80s and 90s. So it's all about these sort of cross-selling opportunities. Is that still the way you see it as well, Matthew?
Yes. But there's another angle to this that is starting to emerge, which is if you take a step back from what the role of insurance is and you look at for a corporate particularly, what are the real threats that they've got? And in the past, people have very much bought insurance, or companies have bought insurance very much on a product by product kind of basis. So they might cover their buildings, they might cover their casualty, they might not insure certain things and self-insure. But really, if you look at the losses, I mean, for example, Pacific Gas and Electric ended up with close to $11 billion liability from the wildfires, almost went bankrupt on the back of it. When they were looking at their own insurance, I bet that wasn't one of the things they considered, was were they going to go away as a company because of wildfire loss. Boeing recently. So I think, in addition to the sort of, it's going two directions in a sense. Insurance is going down to the more detailed level, which is linked into when you're buying something as a personal consumer, but his whole balance sheet protection and the loss that can accrue to a big corporate is something that people are starting to wake up for. I think what that's really healthy for that is that it's no longer just a buying decision that sits with the risk manager a few levels down in the organization, but the CFO and even the CEO are now getting much more interested, and actually they're being driven that way by regulation from what's required of boards to actually really understand what could potentially actually just take the company out of business altogether.
So what you're saying is actually that's positive for insurance, because insurance is bringing a lot, is able to bring a lot of value to that sort of party to be able to explain to an industry in one sector all the other potential hazards that they perhaps hadn't thought of. The hazard of, as you that example of wildfire to banking is not immediately apparent, or perhaps earthquake to banking or other things.
Yeah, I mean, we all have this attitude to risk. We tend to react to what happened most recently. So you saw it with hurricanes in the US. There weren't any hurricanes of any significance for 10 years. People sort of forgot about hurricanes to a large extent. You see it with pandemic, interestingly. When we were at RMS, we were building pandemic models, and that is a real threat, as we know, just now with what we're seeing with what's going on out of China. But actually, until there's a real loss, people don't really do a lot about it. And this a little bit goes back to what Robin was talking about with this whole move to having to have a new digital platform. The reason that people aren't taking the big investments and actually really tough decisions about how you build a new digital platform that's going to disrupt your existing business is because it's not a burning platform, top 5 priority for a business. So I think the sense of, if you can take a step back and actually have an approach to understanding risk, which doesn't have to sort of focus entirely on the individual events, but just recognize that bad things do happen, and it can be the end of a company or sadly the end of a person, and then you think, how do I protect against that, even if I don't know exactly what it's going to be? You get a very different way of looking at the risk.
Something I wanted to ask both of you. We've got an interest. Is any of this paralysis down to an inability to know which new technology to adopt? So we could use an analogy with the cars at the moment. You can see that actually new car sales are down. It's not necessarily just down to economics of world growth slowing. It's actually down to people having no idea what kind of car they're supposed to buy, because actually public policy seems to change every 5 minutes and has just changed in the UK. Suddenly you thought you might be able to buy a hybrid, but actually you know that in 15 years' time the hybrids are sort of going to be on their way out. So would you buy a hybrid? Going back to the incumbent insurance industry, is part of their problem not that they don't want to adapt and they don't want to digitize, but they just don't know what to adopt. They don't want to end up with a Betamax when VHS is coming. Is there any of that, or is that just I'm being too kind to my industry?
Well, there's nothing wrong with being too kind to the industry. I think there is a bit of that. I think that many of the most senior people in big technology, CIO, CTO, COO type jobs, have a certain knowledge of the technologies that they've traditionally dealt with over 10, 15, 20 years. They are less... I do think there's a sort of curiosity problem. They're not inclined to look in parallel universes to engage broadly with the Amazons and the Googles and the Microsoft Azures and the next generation of platforms in a way that I would have thought would be helpful. Is it
really a false problem? A lot of these cloud platforms that you're talking about, they're much more interoperable these days than they were before. It's not like a VHS, which literally is the different size socket, different size cassette than a Betamax. Or people creating problems that they don't really that don't exist.
I mean, there's a slight problem in the sense that none of the companies have. Those companies are known for a sophisticated knowledge of the insurance domain, and there's a sort of sense in insurance that that's a prerequisite. But those platforms, those cloud platforms that Google and Amazon and Microsoft provide, are now extraordinarily well equipped. They are already, every single microservice that they can provide has an API attached to it. They are, enterprise in every meaning of the word, and many of the companies that are responsible for big transformation projects have built pretty sophisticated tools on the back of them. So I think they have a role to play. They themselves are a little bit reluctant to enter the space for the reason I talked about earlier, which is they collide with legacy tech, and they don't get to look that special when you have the sort of deeply compromised stack. They're still after the opportunities that would enable their technology to be optimized and generally look like the technology of the future.
Yeah, there's a comment Jeff Bezos has, which is how he thinks about what he calls irreversible decisions or different types of decisions. And his view is, if there's decisions you can make and if things don't work out, you can change your mind and it's not too expensive. Don't spend too much time thinking about them. But there are certain things in life that are irreversible decisions or just are hugely expensive. And I think this is part of the challenge that companies do have, Mark, to your point. There is more flexibility. There is a lot more interoperability out there. One of the big challenges that CEOs have across all industries, not just insurance, is they don't really understand, and this is not a criticism, it's just a fact of life, what their CIOs and CTOs are telling them. So they don't necessarily know what the right decision is to make, and they're very scared of going down that route of an irreversible decision and making the wrong choice. The other part, though, that we don't really talk about, but I think is incredibly important, is this whole factor of usability. And if we can learn a lot from what we're seeing with the consumer products we use. If you look at the various apps or Netflix or Amazon, they're highly usable. They spend a lot of time and money configuring them so people can use them. And we don't really have that luxury in commercial technology. Things have to get out there. And the reality is a lot of the barrier to change comes down because people are given some new technology and the initial reaction is it's too hard to use, doesn't allow me what I'm going to do, it's not flexible. And so it takes actually quite a long time to actually get those embedded. And so I think part of what we need to see going forward, and it comes back a little bit to Robin's point again about how does this change get made. If you can get people who are using the technology to really love using it and actually know this is designed for them and find companies that can engage with the users, then you can make the change. But you add another level of complexity to something if it's not.
Well, I think for me, it's a good time to start talking about an ecosystem. For one, we've been talking about digital ecosystems. Within insurance, we talk about the London ecosystem. Do you think that's is it a fair comparison to say that that we have a commonality of interest in the London market? That it's another type of ecosystem. Is it?
Oh, look, it's an absolutely perfect example of an ecosystem. I think it has its unique challenges right now. To your point about what is holding back these sort of decision making, at the highest level, and once you got once John Neal and his new leadership published the blueprint, which I thought was brave and admired, and I like. They have unwittingly, of course, caused some paralysis in the sense that now everybody is waiting to see what the next iteration of that will be, what technology will be built on the back end. My personal interest is in what the simple risk and the complex risk exchanges will look like. But until Lloyd's has defined what those will be, put in place management teams to run them, determine what budgets are, determine which suppliers they want to work with, everyone will sit around going, I'm not going to build one of these myself. I'm not going to make a big decision on my next generation of technology because I need to know what that looks like before I make those decisions. It's not answering your question, but that means that the ecosystem at Lloyd's, it will for 2020 be pretty much paralysed I think in terms of making those big decisions.
I suppose going back to when you think of ecosystems, of course, when we were talking about biological, botanical ecosystems, you're actually talking about Darwinistic ones, ones that in which different species and different ways of doing things thrive or die out. But here we're looking like something that's going to be a top-down mandation, making something compulsory, saying we will choose VHS rather than Betamax, and do you think that's a problem? Or because we've had, I suppose we've had a cycle of this kind of thing over the years. People who all the three of us in this room who have been around long enough to see it. Of let's mandate something, say something like Connect at Lloyd's, and then that failed. You come in. Richard Ward said, let's be more Darwinistic. Let's just go peer to peer. Let's just sort of, let evolution take its course, and some things will come and some things will go, but then something will emerge as the dominant species of the way of doing electronic placing in the London market. Which way do you jump on this? Do you think the people with this blueprint are just going to have to mandate stuff?
I think John Neal's seen for himself the previous 10 years. He's heard a lot of people complain about the usability of the PPL and has decided that's not it. He's seen for himself how difficult it is to get market consensus, how difficult it is to run top quality procurement across, as a market rather than an individual. And he's gone full circle back to effectively the Connect days and said the only way we're really going to build the technology of the future is to get a smart group of people together, I guess, get the Amazons and the Googles and the Microsofts in the room and say, we're building the next one. And he's raised a lot of money to enable him to have the ability to take a 5 to 10 year view of those things and get something out there. Look, whether or not it gets adopted thereafter, that's another thing. Mandating it is one thing, but if you're a disruptor like me, whatever someone tells you to do, you normally do the opposite. So that problem remains out there. But I think he's doing the right thing. You have to be brave. I think we've danced around this discussion, in this issue, in this discussion. At some point, somebody just has to be really, really brave and go, this is what we need, and I've got the balls to go out and build it and pay for it.
And it's brave because you have to be right. It's all very well being God and decreeing that the Neanderthals should inherit the earth when it turns out it was Homo sapiens after all, and you got it wrong.
Well, I mean, another analogy is the HS2, or for those from overseas, a high-speed train. And there's a big debate just now about the fast train going from London up to the north, which is now getting close to £100 billion of cost, 3 times the overrun. Yeah, it's a much larger version of the same problem, which is either you've got the vision about something that is going to come into play 20 years' time, and you just have to go for it and recognise it's going to be expensive and it's not going to pay off for a while, or you don't, and you try and find a commercial solution. And I think, as Robin says, that the real challenge within Lloyd's, which we sort of keep coming back to, is the short-term commercial benefit doesn't work for somebody coming in on a pure commercial play. So if you sort of said, right, okay, let's go down the kind of Darwin or let commercial forces drive this, you're going to have a version of what you've already got because there's not enough drive to make the change in the time that's needed. So I think it is one of these situations, and they are really tough because everybody's got reasons why they want them to fail. They don't like the money being spent. There is a bit of risk, and by the time it's failed, the person's probably left. But I think that is a choice the market has in front of it. I think we're all saying you've got to be a brave CEO and say, do it, and I'm going to back it, and we're going to push through.
I can't draw any symbolism from this, but I'm one of those people who's had their DNA done, and just for the record, I've got 0.3% Neanderthal in my DNA. 97.7% is Homo sapiens, but we all probably have a little bit of Neanderthal in there somewhere, lurking in our DNA.
So, in terms of London market reform, you're not you're broadly positive, and some people would. Some of the criticism I've heard of it is that it's not ambitious enough. Is it ambitious enough for you guys? I mean, there's so many strands to it. It's ambitious enough for me.
It's ambitious enough for me. I'm often sort of labelled a gloomster in all of this. But truth is, I'm not. I mean, I admire John Neal for what he's doing. I don't think that right now there's any other way. And my frustration is about the opportunities that lie out there. All these new risks, all these changes in the way that we're going to have to provide these services, which we're not going to be able to do unless we bite the bullet. And I'm not one of these who goes, insurance is dead. London's going to get its comeuppance. It's actually about, unless we make these changes, we will not have as broad a horizon of opportunity as we would do if we were able to make these changes. I wouldn't be doing this after 20 years if I wasn't a relentless optimist, and I couldn't see blue sky ahead. But it's, to me, it's a frustration of thinking of all the wonderful things we could do if we got it right.
Well, Mark, just to answer your question in a slightly different way, I mean, I've always been a great fan of the London market. I mean, when the days when we had a single owner of a telephone system in the UK under British Telecom, Hull had its own independent telephone network, and the reason for that is where British Telecom used to try out all of its new technology and innovations and things without risking the whole network. In our days at RMS, we used to see London as a wonderful place to try out new models and tools and analytics, because there's so much variety in here, so much going on, very quick decision making, you're very entrepreneurial. And the theme behind this is how do you allow a marketplace to have the right technology, digital enablement, and at the same time protect the capital base, but also allow the entrepreneurs to flourish and don't either hamstring them through too much regulation or too much cost. And so ultimately, the market has to fulfill its role in supporting the people that it relies upon to trade on. And one of those things is giving it a robust platform to trade with, but not charging people disproportionately and not giving them control.
What about this? I like your Hull analogy. Do you think we could have the equivalent of a Hull, in the London market network, to say we've got a kind of sandpit where we can go and play and not, jeopardise the whole network?
Well, it does seem to be a theme to send off London-based large organisations to different parts of the northern part of Britain. So maybe we could hive off some of Lloyd's to somewhere up north.
I think it's going to happen naturally, isn't it? I mean, if I was John Neal and I was running the complex risk exchange, the first thing I would do is get a couple of people to run POCs in the equivalent of a Hull as a place rather than a class of business, and see how it went, and naturally the one that performed best and the one that looked like it had the answers would become adopted over time. I see. POCs with startups are starting to completely disappear, but a POC with an Amazon or a Google or a Microsoft is another thing altogether. And they're very, very keen to enter the space and prepared to put plenty of skin in the game. And I still think that they have much to offer us.
And just to sort of decode that, perhaps techie jargon, POC is a proof of concept. So it's trying something out with somebody, with a partner.
Yeah, and just picking up on what Robin said there and actually using Hull in its other version, which is actually literally the insurance of Hull, it's important the market allows a multi-track process on this. So if you look for a company like Consiris, for example, which is successfully tackling some of the challenges of underwriting in marine, which writes Hull, and traditionally has been one of the most old-fashioned ways of writing business, they have successfully managed to persuade marine underwriters to bring in new technology, and partly because they're leapfrogging from when people are just doing things in a very old-fashioned way to doing something quite new. And so as part of that, I think the trick when you build these sort of big centralized systems is all the time keeping an eye out on what's happening around you, because at some point you might have to say, actually, you know what, someone else has built some better technology here. And the fact that we've got more interoperability now, we've got things like APIs, we've got another part of the whole ecosystem, one we didn't talk about, but is the people that are building platforms that technology can run off, and you're not limited to a single platform. Is another angle to this, which is Robin says, if you allow, Mark, to your point about Hull the place, if you allow in certain areas to flourish and don't again constrain them too much or force them to sort of use the main system, particularly in the areas where you've got new risk, I think that's again, it's quite hard to find the next best version of a property exposure analytics that allows you to underwrite property better for lots of reasons. But if you are the person that figures out how to understand supply chain and can find a way to give underwriters tools to write supply chain, then please do let those organizations flourish and create a whole new revenue stream coming into the market, and don't constrain it by the main system that is going to change the sort of the core business, because that would be a disaster.
Well, I think we should talk about Instech and some of the insurtechs. I really want to talk about that event that you did with MasterCard. What did you take away from that? You're about to put out something. I just thought it was fascinating. It was a fascinating evening. It was slightly surreal to see so many people come out on a sort of rainy Monday evening, and it was cold and dark. To hear about payments and the technology behind payments and how it might interact with insurance. But it was a full house. It was 250 people. What did you take away from that? I thought it was it was awesome.
Matthew and I had a little debate about this. He was a bit stiffy about it when we first did it. He'll want to come and talk about payments. And with about a week to go, I was a little bit worried too because we hadn't got a full house. And then suddenly it was full. I've made this point before. Insurance is two things. We don't have a physical product. We don't have to build a car before we sell it. We exchange data and we exchange money. I mean, those are the absolute, raw materials of insurance. And I think a lot has been talked about data these last 10 years and big data and external sources of data, but very little has been talked about money. And we exchange it day in, day out. My second takeaway is, and I think you've made this point eloquently before, when companies like MasterCard enter the space and say, we have connections to every bank, we want to help you move your money better, we have vast amounts of money that we can deploy to R&D, we are very strongly focused on making the world a better place, sustainability, microservices, inclusion, we would like to work with you, then somebody should bite their arm off and go and work with them, because they and people like them can make a vast difference. And I remain a startup supporter, and I'm going to do everything I can to help fellow startups because I have a certain empathy with them. But the biggest difference in the next 10 years will be made by decisive interventions from companies like MasterCard.
Yes, I think from my own perspective, studying the industry and writing about it for so long, I thought, goodness me, actually, if when I was sitting at your event, a few weeks ago, thinking, we've had the Rushlicon initiative, and you're talking about net settlement of just a few $100 billion here and there, but I thought, well, actually, if we'd had MasterCard in the room when they set up the Rushlicon initiative, we might have solved it by now. But that was my takeaway.
We try to design this so people turn up and know they're going to get a benefit, not just by who they're seeing on the stage, but also just all the people they're going to meet on the day. We've had a lot of people, yourself included, who've met some partners, business partners mostly, and maybe some romantic ones there too. They found capacity in there, they found clients, they found employees. The whole thing that goes on in and around actually what we put on stage works. And also we're delighted that, and much to Robin's surprise, given some of what he was told by his teachers, that the CII have now given us credits, or given people turning out credits for their continual professional development, and part of that is they quite like the way we sort of balance the education with some of the humour on there. So I think the trick with anything, and as you well know from your days as a journalist and getting people to engage in content, is you've got to make it interesting, you've got to make it kind of fun, but you've got to get the facts and you've got to get the good people together to bring all of those into your readers or your listeners or your viewers.
I like the fact that I can have a glass of wine while I'm there as well. I mean, that's pretty good. And tell us about this Google event, because it's been the elephant in the room, and I suppose it was the sort of great bogeyman of the early days of Insurtech, and you could sort of, I suppose in the first couple of years of putting on Insurtech events, you could just sort of, an executive would get up and say, look guys, if we don't sort ourselves out, Google, Amazon, they're all going to come and kill us and destroy our industry, and we'll all be out on the street. That gave way to a certain maturity, should we say now. That's why I'm fascinated to see, what Google are up to, and do you have any kind of you've got any kind of previews of what we might be talking about?
Gracious, no, you have to come to the event. It's a bit like, but I will share this much. I think that Google as insurer, Amazon as insurer, is hugely overdone. I can't think for a minute why they would want to enter the regulated space. What they want to do is deploy to the insurance industry the extraordinary ability to analyze data, leverage their cloud technology, bring Google Earth, bring Waze, bring all those toolkits, to what we do, and they too have a considerable interest in improving the way healthcare. They too are quite conscientious in the way they want to deploy these things. What fascinates me is, and I take this as a great compliment, that they will spend money with us because they think they're going to get access to the people that they need in order to deploy that toolkit. I mean, they are very much part of what got me to this. It's digital, it's not digitize, because they say we find it hard to work with digitize, and we want to work with digital. Instech London, will you help us find the true digital models out there? And that plays right to everything that that I'm trying to sort of drive through 2020 as part of our agenda.
Yeah, and part of this as well is Google Cloud, who are supporting the next event. And what they're really interested in is finding organizations to work with on the cloud. I mean, if you take AWS, for example, I haven't got the figures for Amazon, but AWS, Amazon Cloud Services, only 13% of the revenue comes from the cloud versus all the other things they're doing, but actually represents over 50% of their earnings. So it's a highly profitable business for them, and AWS are the dominant player in the space. So, Google is seeing this very much as them being one of the platforms. Again, back to our conversation about ecosystems, one of the platforms out there. They can bring in as well all the other things we know Google for, but for them, there's so much to play with in this marketplace. And again, back to what we said earlier on, they love what they're seeing in insurance for lots of different reasons.
One of the other things I really love about going to Instech events is, there is an overriding theme, but there's a whole load of other eclectic stuff going on. You have shout-outs for people who just have an open mic at the end of the show and just tell you what they're doing and say, meet me at the bar later. But there are always one or two things that don't necessarily fit in with the overriding theme, just the things that you've been collecting because of your position as a sort of guardians of the technology world. For some of us sort of dyed-in-the-wool insurance types, and you're the great sort of communicators between the two worlds. What are some of the the things I'm jealous of you is you go and you get to meet a lot of these startup companies when they're really, really early stage, and then often it's when you put them on a stage is the first time someone like me will get to hear about them, and I get to meet them, and it's great. So that's one of the reasons why I love coming along. So what are the things? What are some of the businesses that have been you've been most excited about? I'll kick off because I went to your last event. I really, really liked a business called Exante that was talking about providing an insurance product, a parametric insurance product that pays out before a loss happens. And this was specifically on catastrophe weather-related events, and it was for really small limits. And it was focusing on the social problem of perhaps lower-paid workers in Florida, perhaps you're working in a Starbucks, someone who's in and out of employment, maybe in the gig economy or whatever, for whom actually boarding up your house and leaving your job and having to get in your car and drive to somewhere and probably go and stay in a motel, which has probably jacked up its prices, is actually a very expensive and actually life-disrupting thing to do because they haven't really got any savings and they're living from one paycheck to the next. It struck me as a fantastically interesting product, and this would be something that would pay out to $400 or $500 to someone like that, but 3 or 4 days ahead of a Cat 3 or 4 landfall in the town where being actually just predicted in the town where they're living. For me, it seemed like a fantastic social good and a really, really good potentially interesting product, opening up brand new, it's covering protection gap, but it's totally new income for the industry. So what other things have been catching your eye? I'll put you on the spot now because, you've got this great privileged position looking sort of a bit into the future. Yeah,
well, I mean, that is just a great example where Chris Lee from Exante contacted us and said, I had an introduction and can I chat to you about my business? And next thing he knew, he was up on stage. And it's very much part of the theme that we try to maintain with Instech, which is, yes, we love having MasterCard and Google, but we've still got a role for people that are very early stage. We allow people to come along for free if there's only been going 2 years. I guess, one of the organizations I like out there, just talking back a little bit about platforms and exchanges, I'm really interested in what the team at Riskbook are doing. So Ben Rose and Jared Lee, both of them come out of a broking background. They were sort of fairly early in their career, very smart. It's a very challenging space to get into, building platforms for exchanging risks between insurers and reinsurers and brokers. But what I like about them is they've got really high energy. They've built a strong tech team, and they're quite modest at the same time. So they're not trying to solve the world. They're doing it one step at a time. But they've got great vision, and they've also managed to get a beta test out there very early. So they're crowdsourcing input very quickly. It's a lot about this theme we're hearing about agility, fast fail, test and learn. So definitely worth keeping a lookout for those two. That's my kind of one of my picks. Riskbook.
I'll put links to all of these in the notes at the end.
I'm going to sort of macro level slightly. I think that life and health will be the focus for 2020. I think it's come late to the party. I think that cost of healthcare provision, the undynamic nature of life insurance provision are all under the spotlight. I think that if you look at the way investors are thinking right now, I think that they see deploying their money there at least for 2020, while London and in our sort of focus with the big commercial specialty markets is a little bit up in the air. I think that they see that space. And from top to bottom, people want to put their money now into things which have an environmental benefit, which play to inclusion, sustainability, climate change, and that will feed all the way through now to how easy it is to get your money, and the focus of insurance companies on the back of it. A lot of, I think we'll see a lot more Zantes of this world come up in the next 12 months, because that's what people want to invest in. There's a massive need for what they provide, and I think they'll get big support from the investment and insurance community if they come up with the right propositions.
I suppose a business like Exante, this is forward-looking stuff and it's all data-driven. It just can't work with one of these, with a legacy stack of technology, can it? It just can't.
Keep going back there, but parametric is huge. I love parametric. I love what Blink are doing. They have a big story there that would extend. I mean, it has to start in relatively commoditizable classes, but bit by bit, parametric payment of claims will become a bigger and bigger aspect.
Just explain to some of the listeners what Blink is, if they don't know.
Blink is a travel cancellation platform. I mean, they've moved from a B2C play to a B2B play, so insurance companies take it. It completely and totally automates what you need to do when a flight is cancelled. So it simply books you on another flight, or pays out your money, or if you've got a delay, you can perhaps opt for a voucher to the airport lounge and take a bit of money to buy yourself a beer. But it's run by the technology. It's completely 100% automated, and bit by bit, back to my ecosystem play, I don't see why that doesn't get taken by Skyscanner at source, or by Experian at source, or whatever it happens to be, Expedia at source. Those things get baked into an ecosystem so that you get flight cancellation without even knowing you're getting flight cancellation, if you sort of mean. So look, I love parametric, and I think we'll have a separate event on parametric, because I think it's one of the big areas for claims as a whole gets underexposed in all of this, and I think that's one of the ways which there could be a big leap forward in the way we deal with claims.
That's really interesting, and there's a lot to talk about there, because obviously things like you could parametrically, you need to be, you don't want to have basis risk and lump that onto a consumer, for example, I suppose. And so there's tons of stuff. The kind of ethics and the regulatory side of it is going to be really interesting when it starts really kicking off. But otherwise, I've come to the end of the sort of list of questions that I had, and I wondered if you wanted to chip in anything that you thought that we should have discussed that we haven't discussed yet.
Well, Mark, I've been inspired by your years of a journalist at Insurance Insider, and therefore we put out a weekly newsletter which we try to make sure we're not just repackaging other people's news, but as I say, it's handmade from the freshest ingredients. We try to give our view on what's going on. So just for any of your listeners that haven't seen that, they might find it useful, not just to find out what we're thinking about what's going on in the world, but also just about our events and also other people's events. And actually also we're always interested in who's providing funding from competitions or the government or things like that. So it comes out once a week. There's logins on www.instech.london.
And look, from my point of view, thank you for giving us a chance to talk to your audience. When Insurtech started off, it was slightly, in the closet. It was a sort of parallel universe. You didn't dare admit that you were going to start up pitches. But bit by bit, we're going mainstream, and any way which you can help, and which I'm sure you will, in getting us to being more known to the establishment and to the people whom we would like to really get access and influence, then and I think this has given us an opportunity. We thank you greatly for that.
Well, more power to both of you. You've converted me along the way, so thank you so much, and we'll be in touch soon. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.